Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my European opening market comment for Tuesday, September 20th. Well, currencies have traded in a pretty narrow range over the last 24 hours as investors wait for tonight's Bank of Japan meeting and tomorrow's FOMC meeting. The yen was higher on reports that the BOJ will abandon its 2% inflation target, while the dollar also rose as the possibility of a rate hike tomorrow increased slightly. The Kiwi gained on expectations of higher milk prices at tonight's auction. On the other hand, sterling fell on continuing negative sentiment from Chancellor Hammond's comments on Friday that the UK would probably have to give up trying to get free access to the EU market in order to maintain control over its borders. But the currency has since stabilized. The biggest loser overnight was the Canadian dollar, which fell on lower oil prices and Friday's resignation by the chief statistician at Statistics Canada over concern about the integrity of their data. This is the second senior resignation from this agency recently, which is a worrisome indication. As for today, it's likely to be another quiet day in Europe and the US. There are no major European indicators out today. In the US, the only major ones are housing starts and building permits. Housing starts are expected to be down a bit, while permits are expected to be up. So perhaps it'll just be a wash as far as the FX market is concerned. The market does tend to look at starts a bit more closely than permits, even though permits is the more forward-looking indicator. In any event, both are expected to be well above their 6-month average levels, so I don't think there should be any cause for the dollar to weaken. Later in the day, Japan's trade balance is expected to fall on a seasonally unadjusted basis, but to rise on a seasonally adjusted basis. Now, for some reason, apparently just out of habit, the market focuses on the unadjusted figure, so the data could cause the yen to weaken. I think the data should be positive for the yen, though, because if anything, the expected 500 billion yen trade surplus on a seasonally adjusted basis would be the highest since August of 2010. The problem is, though, that the Japanese trade surplus is rising not because exports are expanding faster than imports, but because imports are falling faster than exports. Now, certainly most of that decline is due to the fall in the price of oil and other raw materials, which is a net gain for Japan. But the value of other imports is also falling, which isn't a good sign for the economy. In any event, I think this month at least investors will hold off making any major moves on the strength of this data while they wait for the results of the Bank of Japan's Monetary Policy Board meeting later in the day. Now, I'll be posting a separate video about that and what the Fed might do too. Those will be instead of the North American opening video today. Please have a look at them. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.